We tend to think of a bank loan as a debt that just lasts forever, right? Until it's paid off. But what if I told you there's a legal stopwatch on a bank's right to actually collect that money? Today, we're going to pull back the curtain on the critical and kind of hidden legal tools that banks use to make sure that stopwatch doesn't run out.
So let's just get right to it. Can a bank's right to take you to court to get their money back actually expire? It sounds kind of crazy, but the answer is a resounding yes. A bank's power to sue you isn't infinite. There's a very real ticking clock, and if it runs out, well, the bank's legal options pretty much vanish. So what's behind this ticking clock? It all comes down to a law called the Limitation Act of 1963. Now, this law sets a very specific time frame for taking legal action. If a bank misses that window, its claim becomes what's called time-barred. And that's just a legal way of saying the debt is now effectively unrecoverable through the courts. For the bank, that could mean writing off the entire loan. Ouch. So, this whole concept hinges on what's called the limitation period. Think of it exactly like that legal stopwatch we mentioned. The second a loan becomes due and isn't paid, that stopwatch starts ticking. And once that timer hits zero, the door to the courthouse slams shut for the bank.
So, how long is this period? Well, for most of the loans we think about every day, personal loans, business loans, anything based on a written contract, that stopwatch is set for exactly 3 years. When you think about it, in the grand scheme of finance, 3 years is not a lot of time at all.
But then, look at this. When a loan is secured by a mortgage on a property, the rules of the game change completely. The limitation period skyrockets to 12 years. This gives the bank a much, much longer runway to enforce its rights, because now there's a physical asset, the property, involved.
Okay, so if that clock is always ticking, especially on that short 3-year timeline, how in the world do banks stop it from running out? Well, they can't just hope for more time. They have to actively reset the stopwatch. And luckily for them, they have a very specific toolkit to do just that.
And here are the two main tools in that kit: the balance confirmation letter and the revival letter. Honestly, they might have slightly different names, but they do the exact same job. They are both written acknowledgments from you, the borrower, saying, yes, I acknowledge this debt exists and I still owe it. And the real kicker? Both of these get their legal muscle from the very same place, Section 18 of the Limitation Act. This signed acknowledgement is the key that resets the clock.
So how does this reset actually work? It's simple, but the rules are incredibly strict. First, the acknowledgement has to be in writing and it has to be signed. Second, and this is the absolute most important part, it has to be done before that original limitation period runs out. If you sign it even 1 day late, it's legally useless for this purpose. But if you do it correctly, a brand new 3-year period starts all over again, right from the date of that signature.
Now, besides signing a letter, there's another really common way to hit that reset button: simply making a payment. Under Section 19 of the Act, if a borrower makes even a part payment toward the loan before the clock runs out, the act of paying is itself seen as a legal acknowledgement of the debt. And just like that, the 3-year clock starts ticking again from the date of that payment.
All right, so that covers the basics. But let's be real, life is messy and so are loans. Things are rarely that simple. So let's take a look at how all these rules play out in some trickier, more complicated real-world situations.
This is a really tough one, and obviously it's a very sensitive situation. A bank can't just get a signed letter from someone who's passed away. So, what are their options? How do they keep their legal claim alive?
The bank really has to tread carefully here. The first move is usually to contact the legal heirs. But, and this is a really important point, the heirs are only responsible for the debt up to the value of whatever they inherit. If they inherit nothing from the estate, they owe nothing. The bank can try to get them to sign fresh documents, but if time is running out, the bank's only real choice is to file a lawsuit to protect its rights before that clock expires. This timeline really gives you a sense of the pressure cooker the bank is in. As that 36-month deadline gets closer, you can see their actions get more and more urgent. They start ramping up calls and letters in the final few months, and if they can't get that signed revival letter by the very end of month 36, their last-ditch effort is to file a lawsuit. It is a genuine race against time.
So, after hearing all this, you might just be thinking, okay, this sounds like a bunch of boring routine paperwork. But, as we're about to see, these documents are so much more than just a formality. They are the absolute legal lifeline for a bank's ability to get its money back.
And this quote right here just says it all perfectly. These aren't just items on some banker's checklist. They are critical legal instruments. Forgetting to get this one piece of paper or getting it signed just one day too late could literally mean losing the right to recover millions of dollars.
So let's just quickly sum up why this is all so strategic. For the bank, getting that signature ensures the clock doesn't stop. It locks in the exact amount that's owed, which prevents arguments down the road. It's their number one defense against a loan turning into a total loss because of a legal technicality. And for you, the borrower, understanding this whole process is just as important. It explains why the bank is so persistent about these signatures and the real legal power your signature holds.
All right, before we wrap this up, there is one last very important thing we need to be crystal clear about. Look, this explainer is meant to give you a clear, general understanding of how this all works, but laws can be incredibly complex and everybody's situation is unique. So, for any specific case you might be dealing with, please always talk to a qualified legal professional to get advice that's tailored specifically to you.
And that brings us to the end. It really makes you think, doesn't it? If a rule this fundamental to the entire business of banking can be so easily missed, what other critical financial rules are out there quietly shaping our world, hiding in plain sight? Something to chew on. Thanks for joining me.